Okay, starting to slow down a little bit. So why don't we get started? I don't want to keep the people that showed up waiting any longer. But thank you for joining this webinar. I'm really excited to be able to share this opportunity with all of you. There's a lot of excitement around self-storage right now. The Smart Stop IPO launched on Monday, bringing a spotlight to the sector. $850 million IPO, biggest REIT IPO in a while. This transaction presents a really good opportunity to capitalize on all the reasons we launched Next Century Self Storage. The deal, as we'll go through it, 3 off-market transactions. The acquisition of mom and pop operated facilities ripe for operational upgrade. And all the 3 of these properties are very well suited for our virtual management operating model. So really excited to walk you through it. I will pause on the disclaimer page here for a second. There will be a recording of this video if at some point you want to study that. Jumping to the agenda here, we'll walk through the portfolio summary, lots to talk about on the properties that we're acquiring. Then we'll go in through the investment overview, how the transaction is structured, and the terms of the transaction, et cetera. We'll go through the market overview. I'm at least as excited about the markets here as I am about the properties themselves. The market dynamic here, the supply-demand dynamic here is very much in the owner's favor. So excited about that. We'll talk about the value creation strategy, how we're going to meet our returns, how we're going to make money owning this portfolio. Talk about the capitalization and the expected returns, and then we'll talk about next steps. Okay. So here we have the portfolio summary. 3-property portfolio. It's 2 different sellers. We're acquiring 1 property. The first one, which I call Moffett Boulevard. It is a 29,000 square foot facility, recently redeveloped by a small private equity firm. Around the corner from that facility is Lighthouse, the existing Lighthouse facility that's pictured here. That's another 30,000 square foot facility that opened up in 2023, so brand new. Moffett was recently developed by a private equity firm. This one is brand new. And then Lighthouse expansion is on a vacant parcel of land directly across the road from Lighthouse here. That'll be a 46,000 square foot facility. We'd acquire that property at C of O. All properties have either been recently developed or recently built, so they're in very good shape. Moffett, for its part, having been recently redeveloped with a new roof. It has a new gate access system, recently brought in a natural gas line, and along with that came a brand new HVAC system. So really excited about that facility. They also recently added a brand new phase of the facility. We'll talk about that a little bit more, increased the square footage at Moffett by 70%. So even just the storage units, 70% of the storage units are brand new. So a really good redevelopment story there. The way this portfolio came together, all 3 of these deals are off-market transactions that we dug up on our own. The owners of Moffett are a small private equity firm, like I said, owned and managed by some guys that are ex-Avenue Capital, ex-Blackstone, folks that I know from different life, and who know what we're doing. They had this facility that is perfect for virtual management because of its small size and high payroll. So we're going to eliminate that payroll and create a lot of savings. But we decided to do a transaction late last year around this facility. Through our due diligence of Moffett, we visited all the competing properties, of which, of course, Lighthouse was the first one. As I approached that facility, brand new facility, I walked up to the leasing office door, pulled on it, door's locked. Brand new facility, brand new leasing office. I can see inside, but there's a piece of computer paper in the door. It says Nobody staffs the office. Call the phone number below. My daughter lives 10 minutes away. She'll drive down and rent you a unit. And so when I saw that operating management system, I said, we have to buy this one too. I got in touch with the owners, and we've made a deal to acquire that. He had a piece of land. He built it. He's a merchant builder. He has a piece of land across the road that he's planning on building into self-storage. So we made a deal to acquire that at certificate of occupancy. So all in, and we'll talk about the market a little bit more, but all in, when done, we'll own 43% of the market inventory of self-storage in this very attractive self-storage market, all within a quarter mile of each other. You can actually see Moffett peeking out of the picture here of Lighthouse in the back corner here. That blue door, if you can see that just above it, that's actually Moffett. So as the crow flies, it's 0.1 miles. As if you drive it, it's a quarter mile. All three property acquisitions together would be a total capitalization of $28.5 million. Purchase price of $26.6 million. Not a lot of upfront CapEx. We'll put in our technology. We'll talk about the technology. We got to bring our technology in. We have to change over the signage. But again, 3 brand new facilities or recently redeveloped. So not a lot of CapEx to be done here, which we like. The properties will be closed on 3 stages. The first of which is the acquisition of Moffett, which is estimated to close on May 31st based on our contract. We are currently taking commitments for $3.3 million of equity in order to fund the acquisition and closing of the Moffett Boulevard property. Overall, we're going to raise $11 million of equity into this investment vehicle, but because of the unique nature of 2 different sellers, 3 different properties, one of them is still to be built. Of the 3 properties, they will all close at different times. And so we are just focusing on capitalizing or raising the capital needed to close on Moffett, which is the first acquisition. Again, investment summary, just a little bit more about the timetable here. We're planning on taking commitments through May 1st for Moffett. We'll call that capital about 2 weeks later, middle of May, for an estimated closing date of 5/31. And then again, based on current timeline and discussion with the seller of Lighthouse, that project or that property, we should acquire that at the end of the 3rd quarter. The Lighthouse expansion, just based on the drawings and the permits that the developer and the seller are working through now, we expect to be able to close on that in just about 12 months from today. Because the capital is being closed on in stages, we wanted to create a way that would incentivize and also compensate investors that come into the vehicle early. And so the way we do that is to reward early participation. Early round capital will accrete at an 8% annually for ownership calculations in later rounds, right? Folks that come into Moffett, their capital, for purposes of calculating ownership for later rounds, their capital will grow at an 8% annual rate. Investment terms. Again, total target capital raise is $11.2 million. We're asking for minimum equity subscriptions of $250,000. Again, focusing on the first $3.3 million today. Term of the investment vehicle is 5 years plus 2 one-year extensions, just to make sure that we have a nice orderly exit. But most of the value add is going to happen here in the first couple of years. The turnover, the operating management system, bringing in the virtual managers, reducing that property management cost, all things I'll get to later in the presentation. But instituting institutional quality revenue management, that's all going to happen in the first 2 or 3 years. So, but we do want to have a nice orderly exit here. So we're calling it a 5-year term and 2-year extensions. Distributions will be a 10% return on capital. Then all investors get their money back. And then there's an 80-20 split of profits in favor of the investors. An acquisition fee of 2 points and an asset management fee of 2 points, again, just consistent with the market. Again, to incentivize and to compensate early investors, investors that come in tranche 1 to support the Moffett acquisition we'll have a ROFR or a ROFO on future capital raises in this vehicle. So you'll have, when we go to close on Lighthouse, you'll have first priority on capital commitments to the Lighthouse transaction. Again, all three properties are going to be one vehicle, but in that second capital raise, you'll have priority. I mentioned I love this market. Let me give you some numbers to support that. You know, population density in the 3-mile trade area is over 100,000. Median household income of 126,000. Average household income of 145. So almost double the national average. Square foot per capita in this market is 2. The national average is almost 8. So a significantly undersupplied market. To underline that a little bit, in the Moffitt property, as I said, they expanded that property by 70% by opening up a second phase in July of 2024. They leased up all of that incremental space in under 100 days. So a lot of demand in this market, no supply. The in-place rents here, again, very high average household income. The average rents here, the occupancy cost or the affordability metric, as some other people call it, is about 1.7%. Industry research shows that in a market like this, densely populated, high household incomes, you could push that to 4. So again, the in-place rents at Moffitt are less than half of what this market should be willing to pay. So a very densely populated, affluent, undersupplied market. So one of the key investment criteria here, very strong market to own self-storage. Despite not despite, but in addition to the strong existing market for self-storage, there's a lot of growth in this market too, being driven by, you know, real investment in commercial projects. South Shore University Hospital, which is 2 miles away from our 3-property portfolio, just added a 6-story, 190,000 square foot inpatient tower, right? $500 million project that is ongoing, and it is generating a ton of economic activity and development in our trade area. A lot of developers are building support for this additional facility. When I say support, they're building MOB, medical office buildings for the non-real estate folks, but MOB, they're building senior living facilities, dementia care facilities, senior housing. So all sorts of real estate development is going up that's going to bring more commercial activity, more people into this market. Again, in support of that, we're also seeing a lot of residential housing. Now, there's not a lot of single family homes. There's no room. There's no green space for that. But we're seeing townhomes come up, apartment buildings, condos. And again, that's better than single family housing for us. Well, apartment dwellers are good demand for self-storage. So we're happy to see that growth. A little further away, 7 or 8 miles away from the facility, but Midway Crossing mixed use project is a $3.3 billion project, bringing all sorts of different commercial activity, again, tied to the healthcare sector, but an enormous project that's bringing a ton of economic activity into the market. We're excited to see that. So again, the market is a big part of this deal. I thought this picture was, these are some older pictures, but I thought this picture is a good way to lay out the portfolio, 3-property portfolio. You can see the proximity of the properties to each other in this photo. You can see the density around the portfolio. A lot of rooftops, and that's what you want to see in self-storage. You want to see rooftops. So if you go by road, the properties are a 1/4 mile from each other. If as the crow flies, 0.1 miles. Though many of you may have already seen the video that was in the teaser, but I thought it would be worthwhile just to play it one more time. It's only 60 seconds. Brand new roof on Moffitt, solar panels. There's Lighthouse. You can see Moffitt in the back with the blue stripe. And you can see the land across the road. So on the right there is the vacant land. Again, directly across the road. and a lot of rooftops. That's for closing shot. Okay. Just a couple more up close photos. You got a pretty good look at it already, but good looking facility again. Islip Moffett. I wanted to show you some of the newer storage units, standard storage units, but new, right? And they look it. That's great. Again, Moffett was a converted warehouse, and now it's a 30,000 square foot self storage facility. Lighthouse. I point out here. Here's a side view of Lighthouse. These drive-up exterior access units, very popular, despite the fact the whole property is only 66% occupied. These drive-up units are almost 100. Very popular with commercial users, plumbers, contractors, landscapers. As you can see, you pull your van right up every day, get what you need out of there, and go do work. Competitive set, again, an undersupplied market. But we have, sophisticated players in the market, which I think is to our advantage. I'll point out here that 2 square feet per capita, we talked about that, way under the national average. But even after the development of the Lighthouse extension, we're under 2.5, right? So 2.5 versus almost 8 as a national average, still undersupplied. So we feel really good about that. Again, the Moffett Boulevard expansion leased up in 100 days. And there's no new development in the market. So we feel good about that. Public storage and extra space are our primary competitors in the market. We feel good about that. It's good to have rational players in the market. They're going to be driving rents hard. So we'll never have to lead the market on rents, which is to our advantage. So I want to switch gears a little bit to the value add and how we're going to make money owning this portfolio. And it comes in, really 3 buckets. I'll start with the middle one first, revenue optimization. That comes along with raising rents, increasing occupancy, and collection of ancillary fees, primarily tenant insurance, right? Tenant insurance can be anywhere from $13 to $20 a month, and we'll keep half. Tenant insurance participation at Lighthouse in particular is very weak. And so there's an opportunity there. The Moffett Boulevard property is 95% occupied. The opportunity there is in driving rents. The rent per square foot is very low because they, like I said, they recently leased up a big chunk of the property, phase 2. And to do that, they rented it at very low web rates because occupied space is better than vacant space. So get the tenants in, paying at a low basis, and then you march those tenants up with existing customer rent increases. For folks that aren't familiar with self-storage, an existing customer rent increase is an updated rent. And so what happens in self-storage is you have a 30-day lease. Tenant is able to leave after 30 days, or every 30 days they can leave, but also every 30 days we can raise their rents. Now, you don't raise the rents every 30 days, but you have the opportunity. And so generally what we look to do is raise people's rents every 6 to 9 months. And so marching people up through rent increases over time is the way to capitalize on tenants that intend to stay, that are paying below their threshold. And we'll also be managing web rates seasonally throughout the year to get people in at a good basis. And then once they're in, we march them up to their threshold as well. We'll talk about what those thresholds are. We have very good market transparency in the market as to what people are willing and able to pay. The other part of it is, our tech-enabled tenant acquisition platform. And we'll go a couple slides back. We'll talk about the stories and the stories technology. But for instance, as we talked about, and I don't mean to pick on the Lighthouse guys, but there's no website, there's no e-commerce enabled website. You can't go to a Lighthouse self-storage website and rent a unit, right? There's nobody in the office, and there's no call center. The call center is the owner's daughter's cell phone in her pocket, right? And so in spite of those obstacles, they have the property 66% occupied. The property right around the corner, which has some institutional management, is 95% occupied. So we know what the bogey is. The two properties on Saxon Road, the two REIT-owned properties, Public Storage and Extra Space, also 95% occupied. So there's real opportunity there to increase occupancy and increase rents at Lighthouse. We will increase rents at Moffett, and we will eliminate a very significant chunk of the operating expenses through our virtual management operating model, which I will showcase right here. When people ask me what is virtual management, I love to just show them this picture. I love this picture. This is virtual management, okay? And so what this shows is when you walk into a Stories facility and you pull the handle on that door, there's a magnetic lock on the door, and that magnetic lock will send an electrical signal to the virtual management office in Birmingham, Alabama. It'll turn on this video wall, and it'll turn on the iPad, right? They're on, but it alerts the iPad and alerts the video wall. And so when you walk into when you trigger that magnetic lock just by pulling that door open, within 5 seconds, there is somebody on that video wall, just like there is here. This is Greg. I know him. I've met him. He sits in Birmingham, Alabama, wearing a Stories golf shirt, and he's got the Stories logo behind him. Within 5 seconds, he's on screen greeting you. Welcome to Stories. How can I help you? I've gotten the question before, is this an avatar? Is this a bot? No, this is a warm-blooded human being named Greg. There's 11 virtual managers in Birmingham, Alabama, and Greg is one of the best. So when you walk in, he'll greet you, welcome to Stories, how can I help you? And you'll say, I'm looking for some storage, or if you're an existing customer, you just need a code to the men's room, he can give you a code to the men's room. If you're an existing customer and you need a lock, he'll point you to where to get a lock. And if you're looking to rent a unit, he'll direct you to the iPad and walk you through the whole process. The video wall is kind of the sexier piece of the technology, but a lot of the efficiency happens in that iPad. And part of it is because it has a camera on it. Now that iPad's on a podium and it's secure, but that camera is where a lot of the magic happens. Because in other kiosk-oriented or automated environments, what happens is you get up to the kiosk and then you spend the next 10 minutes typing away on this giant keyboard, your last name, your street address, your driver's license ID number. It's tedious. Now, because the iPad has a camera on it, we eliminate all that. You pick your unit size, it asks you for your personal information, you hold up your driver's license, it captures it. It asks you for your payment information, you hold up your credit card, captures your payment information. Click here to accept terms and conditions, click here to e-sign your lease, and you're done. 30 seconds later, you get an email with a code to the gate, the big access gate outside, the iron gate. You get a map of the facility with your unit highlighted in yellow, so you can go drive your car over to your unit. And you get a copy of your lease, which most people don't read. So it's really slick technology. It's amazingly inexpensive to license and deploy. Outfitting an entire leasing office, including demoing the office, white boxing it like you see here, hanging the units, the electrical work needed to operate all this, and the magnetic lock on the door, under $50,000 a facility. Really cost efficient to do it this way. And it's a superior tenant experience. If you look into the Public Storage, which is the largest public self-storage REIT, if you look at the Public Storage investor presentation, there's a page in there that tells you that if you go into their office, you will typically be in there on average 45 minutes. You're in and out of our office in under 5. If you want to ask a bunch of questions, you can ask as many questions as you want. But if you just want to rent a 10 by 10 unit, you hold up your credit card, driver's license, click, 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 you're out. And it's a much better experience for the tenant. It's streamlined, so much better. We talk about facility operations. We talk about the savings. Here's a real live example, and this comes right out of the. These are numbers that are related to the 3-property portfolio, right? So EGI is effective gross income. Traditional REIT, in this case, we use Extra Space, which has the largest third-party management portfolio. So if you hire a traditional third-party property manager is going to manage the property for you and put a live human being in that office, they're going to charge you 6% of income. Because Stories' platform is much more cost effective, they're only charging us 4.5%. Now, there's a couple other fees that come along with that. We pay a fee that kind of compensates the virtual managers. We pay a fee because we pay a salary to a part-time repairs and maintenance person, usually a 1099 employee that we'll have in market. He'll touch the facility for about 10 hours a week. We guarantee him 10 hours of work a week. And we pay him somewhere around $20 an hour. And that employee has a whole checklist of things that they do weekly, but they sweep out units when people move out. They do lock checks, they do lock audits. They'll drive around the golf cart and pick up trash and throw it away. That person's important. They're on our payroll and they're on this analysis. But all in, just in third-party management, you're saving over 45% by managing the property on a virtual basis. And it's a better customer experience. Excuse me. If you factor in the fact that Extra Space does not share in the tenant insurance income, which is just a quirk in the self-storage business, but they don't share the tenant insurance income. With our relationship with Stories, we keep 50%. So if you factor in the tenant insurance income that we keep, the cost of third-party property management is 66% less through virtual management. If you put a 6 cap on the $300,000 that we plan on saving on a stabilized basis at the 3-property portfolio, you put a 6 cap on that, it's $5 million of value creation. Okay. Just a little bit about Stories third-party management platform. They manage about 50 properties on a third-party basis. They have 11 virtual managers, so it's about 5 to 1. 5 properties for every virtual manager. 3 million square feet, 20,000 units, 21 states. Very considerable management platform. Their average Google rating last year was 4.7. So again, people like the customer experience. They like the virtual management experience. It's quick, it's slick, people like it. It's just, anyway, it shows in the ratings. Again, value-add drivers, we talked a lot about this in terms of revenue management, operating expense savings. Lighthouse is a classic mom and pop property where we're going to bring institutional quality management to that facility to increase revenues. What's really interesting here on the revenue management side is, through our due diligence, we have transparency into the rents that our competitors are achieving. So you can see here in the bottom right, the Public Storage on Saxon Road, the average in-place rent at their facility, which is approximately 95% occupied, is $32. At Extra Space on Saxon Road, again, a mile away, is about $34, about $33 an average between those two facilities, which are right next door to each other. Islip and Moffett and Lighthouse, again, about $21.50, $22 on average as they start to raise their revenues. So there's an upside to the rents in the facilities we're buying at 50%. Our rents are way below market for rational reasons we've gone over, but Lighthouse is just not being professionally managed, and they're not raising rent. They don't have a revenue optimization strategy in place. And Islip, the Moffett Boulevard property, professionally managed, but they recently just filled up 70% they increased their square footage by 70% by bringing in tenants at a very low basis, and they're in the process of moving that up. Since October 31st, when they physically stabilized, got that second phase occupied, to today, they've increased the rent roll, or increased rents by 16%. On an annualized basis, that's over 50%. So we're way ahead of our pro forma, and we don't close for another 2 months. Again, sources and uses of funds. Self-storage lenders are underwriting to about 65% loan to purchase price. We have 2 competing term sheets here for a $5 million first mortgage loan, which gets you around 65% loan to purchase price. Again, the CapEx here up front is low, mostly signage and technology, because properties recently redeveloped. So on an $8.3 million transaction value and a $5 million mortgage, the equity we're raising today is $3.3 million. Again, across the three properties, three closings, it'll grow to 11 million in this vehicle. Projected returns. I wanted to show this page because nothing is certain in life. So the Moffett Boulevard transaction is very near term, and then Lighthouse existing comes after that. The third closing would be the expansion a year later. So we wanted to show what the returns would be if we close on just Moffett, if we close on Moffett and existing, and if we close on all three, right? And of course, all three ties back up to the front, of the book. But there could be, for one reason or another, the expansion never gets built. So here you understand what the target IRR or the expected IRR is if the expansion never gets built. For one reason or another, we may not close on the Lighthouse transaction, the existing. I don't know why, but it could happen. And if that doesn't happen, then you can see what if we just end up owning Islip Moffett, the Moffett Boulevard property, then you can see what the returns are there. We have not underwritten any type of debt refinancing mid-hold, although that's a likely scenario. We get the Moffett Boulevard rents up, we take out the operating expense savings, we get Lighthouse rented up, we have that operating model in place. There may be an opportunity to refinance the debt, increase proceeds, take out some capital, return it to investors. None of that is run through our numbers, although that's a possibility. So we're at the recap. Again, prime location, densely populated, affluent market with strong demand for self-storage. Inventory is very low. No self-storage in the pipeline that's in the public records. Pro forma for all three acquisitions will control 43% of a very supply-constrained self-storage market. Value-add drivers are in place: mark-to-market of in-place rents, mark-to-market of occupancy at Lighthouse, and the opportunity to reduce property management expenses by over 50%. Compelling returns. We're making development-like returns through acquiring property without taking development risk or construction risk. That to me is a good risk-return opportunity. A little bit about the team. Everybody on this Zoom knows me, so I will not bore you with my bio, but really proud of the team that we've put together. We've been working together for 9 months, going on a year here. And Kiana, Patrick, and Adam are just tremendous self-storage and real estate professionals. Their backgrounds include inland real estate, Public Storage, which again is the largest self-storage REIT, and Storage Rentals of America, which is quietly one of the 20 largest self-storage owners operators in the country. Adam was employee number 1 there and helped build that company to what it is today. So this is where we end the prepared remarks. We're going to turn it over to Q&A in a minute. There's a Q&A button if you are interested. But look, we'd love for you to join us in this opportunity. We are taking capital commitments through May 1st. We've already circled a little over $1 million, so we've got about 2 to go. But excited about this. This is my phone number and my email address. I encourage you to call me at any time. You can expect to hear from me, but of course, call me at any time with questions. As you can hope you sense, I have a lot of passion for this business model and a lot of passion for this portfolio. So I'd love to talk to you about it more. And with that, I will open up the Q&A. Okay, brave soul. Our first question is about the structure, the deal structure. And yes, so are all 3 properties going to be in the same investment vehicle? If I invest in Moffett Boulevard, do I also end up with an investment in Um, do I also end up with an investment in the other two properties? Yes. It's all one vehicle. The only thing that we're doing that's a little different is we're closing on the properties in at 3 different times. And so we're not taking commitments for all the capital at once. We don't want to hold capital that's sitting fallow. We don't want to hold your commitments. So we'll do it in stages over the timetable. But if you're an early investor and you invest in this round, your capital will accrete at an 8% rate annualized. So when we cut the shares for the second round investors, you'll have that accretion to your advantage, right? You'll also have the opportunity, you have a ROFO on those future round of capital. So thank you. Hopefully that's clear. Okay, we've got a question here about the 1099 employee. Yes, so the 1099 employee is sourced, trained, managed, and payrolled, I'll say payrolled, by our third-party property manager. He's on my books. He's on our books, right? So he runs through our P&L, but they source him, they manage him, they train him, they oversee him. The payroll, his paycheck comes from them, but it's on our books, right? So that's a good question. Usually they find them, Craigslist. They put an ad in the local, social media and source folks that way. GMP on secured on addition. Yes, there will be a GMP on the expansion. That's how we develop the purchase price on that property. When do you expect to break ground the expansion? Probably in about 3, 4, 5 months. 3 months they expect to break ground, and then a 9-month construction period is the latest dialogue I've had with the seller at Lighthouse. They're pretty far along with the town, and so they're just finishing up their drawings and getting their permits. They think they'll have a shovel in the ground within the next 3 months and have it constructed and a C of O by this time next year. Okay, so question about the deposit on Moffett. Yes, so we have a $250,000 non-refundable deposit up. It's hard. We have another 2 months to lock down our debt financing and close. Yes, we have annualized net cash flow projections, the IRR numbers. Let me flip back to our IRR numbers here. So these are annual IRR numbers and MOICs. So if we acquire just Moffett Boulevard, the 5-year IRR is anticipated to be 21.8% at 2.5% multiple on equity capital. If we do close on the Lighthouse property as well, that has a higher IRR, as an independent property that has a higher IRR. No synergies between Moffett and Lighthouse, but it does have a higher IRR. There's more value add to be done there. That's the mom and pop operated facility. So that's more like a 25% IRR when we underwrite that independently. The blend is a 23.6, as you can see here, and a 2.7 MOIC. And then all 3 properties together is 27% IRR and a 2.76 MOIC. Okay, I think we got the Lighthouse expansion. The seller's going to GC it. He's a developer. The story was he wanted me to buy the land, and he said, he had a purchase price in mind for the existing facility and buy the land. And I called him and I said, I could buy the land, but then I'm gonna have to go find someone to GC it, someone who's gonna bid it out to the sub, someone who knows how to expedite in the town, someone that's built in Islip before, knows the town, knows the permitting process. And he said, that's me. I said, Charles, I know it, right? So why would I buy the land from you and then go find somebody that looks just like you to go build the facility that you've already designed? So why don't you guys do it? We'll buy it from you at C of O. And that's how the deal was made. So hopefully that answers that question. Questions here about the tenant insurance. Yes, we make tenant insurance mandatory. Tenant insurance mandatory. Store E's across their whole portfolio has participation rates in the high 80s, high 80% area. We make it mandatory. There's if you have a homeowner's policy that covers your self-storage facility, you have 45 days where you can go take the title page, the cover page, and fax it to the Store E's folks, and they'll give you credit for that. Otherwise, you sign up for the storage. So you get near high 90% participation on new tenants. On existing tenants where you have to give them time and they've already been in there a while and you have to give them 45 days, some of them will go take the time, make a photocopy, scan it, and send it to you. So you end up in the high 80s, but participation rates are very good. No dispo fees on exit. No, we don't want to, we just didn't want to do that. How does the third-party management contract? It's a five-year contract. It's a 5-year contract. And the licensing of the the question, apologies. The Store E's contract, our third-party property manager, it's a 5-year contract, evergreen, rolls over. And we actually we pay an upfront licensing fee for the technology that goes into the leasing office. So all of that is accounted for upfront in our CapEx number, the licensing fee. It's a one-time payment. Insurance costs have moved up. The move up from the anticipated move up from 25 over 24 is much less than the move up from 24 to 23. We've seen escalation of about 7-8% this year on other things that we've been underwriting. Exit cap rate is 6. Which is consistent with Green Street's average for this zip code. Yes, are the returns here gross before the split? Yes, they are gross before the split. If I zoom back to the term sheet here, you can see that on average, the target returns, the LP returns after costs and expenses and promote, it costs the LP about 2.5 points on IRR. Oh, let's see if I can get that screen share back. Okay. Okay, let's see here. A couple more questions. Does Store E's guarantee that their virtual manager facility ratio won't get too high, i.e. want your customers to reach that? Yes, no, agreed. Agreed on that. They don't guarantee it, but they do staff it appropriately. And so there's no guarantee there, but they've been on a 5-to-1 ratio for the last couple of years. So what if Store E's bust? Can we run? Yes, we would continue to run it virtually. Store E's actually will train. So part of the Next Century business plan on a broader basis is to achieve enough scale where we can insource or in-house that third-party property management function. Store E's does license the technology on a SaaS-only basis, so we can continue to use their technology and in-house all the virtual managers and the accounting people and the payroll people and the management of the 1099. That is the direction that Next Century is going in, and quickly. Okay, we're out of questions, but that was good. 12 questions. Well done. Okay, Well, if there's no other questions, I'm going to let everyone get on with their evening. I really appreciate everybody jumping on here and hearing about this opportunity. As you can tell, I have a lot of passion for this business model, for self-storage, for the virtual manager business model, and for this portfolio in particular. So I look forward to hearing from you. And if I don't hear from you, you're going to hear from me anyway. So I look forward to it. Thanks everybody for joining.